Hi, and welcome to CPAaccountantsirvine.com. Let's talk about inventory and expenses in your business. Inventory is usually the largest current asset of a business that sells products. If the inventory account is greater at the end of the period than at the start of the reporting period, the amount the business actually paid in cash for that inventory is more than what the business recorded as its cost of goods sold expense. When that occurs, the accountant deducts the inventory increase from net income for determining cash flow from profit. CPA Accountants Irvine shows the prepaid expenses asset account works in much the same way as the change in inventory and account receivable accounts. However, changes in prepaid expenses are usually much smaller than changes in those other two asset accounts. The beginning balance of prepaid expenses is charged to expenses in the current year, but the cash was actually paid out last year. This period, the business pays cash for next period's prepaid expenses, which affects this period's cash flow, but doesn't affect net income until the next period. Now let's talk about growth. As a business grows, it needs to increase its prepaid expenses for such things as fire insurance premiums, which have to be paid in advance of the insurance coverage and its stocks of office supplies. Increases in accounts receivable, inventory, and prepaid expenses are the cash flow price a business has to pay for growth. Rarely do you find a business that can increase its sales revenue without increasing these assets. The lagging behind effect of cash flow is the price of business's growth. Managers and investors need to understand that increasing sales without increasing accounts receivable isn't a realistic scenario for growth. In the real business world, you generally cannot enjoy growth in revenue without incurring additional expenses. And now let's talk a little bit about depreciation. Depreciation is a term we hear about frequently, but don't really understand. It's an essential component of accounting, however. Depreciation is an expense that's recorded at the same time and in the same period as other accounts. Long-term operating assets that are not held for sale in the course of business are called fixed assets. Fixed assets include buildings, machinery, office equipment, vehicles, computers, and other equipment. It can also include items such as shelves and cabinets. Depreciation refers to spreading out the cost of a fixed asset over the years of its useful life to a business, instead of charging the entire cost to the expense in the year that the asset was purchased. That way, each year that equipment or asset is used bears a share in the total cost. For example, cars, trucks are typically depreciated over 5 years. CPA Accountants Irvine knows this idea to charge a fraction of the total cost of depreciation expense during each of the 5 years rather than just the first year. Depreciation applies only to a fixed asset that you can actually buy, not those you rent or lease. Depreciation is a real expense, but not necessarily a cash outlay expense in the year it's recorded. The cash outlay actually occurs when the fixed asset is acquired, but is recorded over a period of time. Depreciation is different from other expenses. It is deducted from the sales revenue to determine profit, but the depreciation expense recorded in a reporting period doesn't require any true cash outlay during that period. Depreciation expense is that portion of the total cost of a business's fixed assets that is allocated to the period to record the cost of using the assets during that period. The higher the total cost of a business's fixed assets, then the higher its depreciation expense. Depreciation reporting can save you money on your taxes. Depreciation of a business's fixed assets, such as its buildings, equipment, computers, etc., is not recorded as a cash outlay. When an accountant measures profit on the actual basis of accounting, he or she counts depreciation as an expense. Buildings, machinery, tools, and vehicles, furniture all have limited useful life. All fixed assets, except for actual land, have a limited lifetime usefulness to a business. Depreciation is the method of accounting that allocates the total cost of fixed assets to each year of their use in helping the business generate revenue. Part of the total sales revenue of a business includes recovery of costs invested in its fixed assets. In a real sense, a business sells some of its fixed assets in that sales price that it charges its customers. For example, when you go to a grocery store, a small portion of the price you pay for eggs or bread goes towards the cost of the buildings, machinery, bread ovens, etc. Each reporting period, a business recoups part of the cost invested in its fixed assets. It's not enough for the accountant to add back depreciation for the year to bottom line profit. The changes in other assets as well as the changes in liabilities also affect cash flow from profit. The competent accountant will factor in all the changes that determine cash flow from profit. Depreciation is only one of many adjustments to the net income of a business to determine a cash flow from operating activities. Amortization of intangible assets is another example that is recorded against a business's assets for the year. It's different in that it doesn't require cash outlay in the year being charged with the expense. That incurred when the business invested in those tangible assets. For more information and to schedule a free consultation, please visit us at cpa-accountant-irvine.com.